Hello, everyone. Welcome to this particular session on impairment. Impairment of assets is a serious topic in CPA Section 6. My name is Dr. Joshua Aura. I teach AFR and AFM at RCM Publishers Online College. Great. So I have some notes with me here that I would want to share with you. I hope you are able to see my screen. So brushing through the concepts, we are told here impairment of assets, IAS 36. The main agenda of this particular standard is to enable us identify possible impairments, external versus internal, perform impairment review, if identified, possible impairments, very important for you to understand that. And of course, how do we record the impairment in the financial statements? So under recording of the impairment on the financial statements, we shall be able to have an extract of the statement of financial position and an extract of the statement of loss and other comprehensive incomes. Now, back to our first agenda, indicators of impairment. So when we talk of impairment, an impaired asset is an asset that has lost value. So in short, when we talk of impairment, at the end of the day, we must compute what we call the loss in value, or what we call the impairment loss. Impairment loss. So how do we get impairment loss, my friends? We shall be taking the carrying value. The carrying value minus what we shall be calling the recoverable value. Recoverable value. Carrying value is this particular value that we carry our assets in our books, what we basically call the net book value. What basically we call here the net book value. If I could just repeat this a little bit, impairment loss equals carrying value or net book value minus recoverable value. Great. So ladies and gentlemen, what will be those indicators that will show you that for sure you need to write down the asset, the value of the asset that you have. So indicators of impairment from your syllabus, they want us to discuss what we call external sources and internal sources. So external sources, two of them, when there is a significant decline in the asset's market value. So ladies and gentlemen, you have bought an asset, say for 3 million Kenya shillings. And then, of course, after some 1 or 2 years, when you pass by around, for example, in shops that you bought this particular asset, you realize that there are other now shops, or even the shop that you bought this asset from, that is even selling your type of asset at 500,000. You bought it for 3 million, and right now you're able to see that the market value is about 500,000. That is a serious indicator of an impairment loss of an asset whose value is declining. So you need to recognize that impairment loss to do what we call an impairment review. So the first indicator is the reduction in market value of your asset. That is very important for you to appreciate that. Ladies and gentlemen, the other reason that will make you know that your asset is really moving down value-wise is a significant adverse change in the technological, economic, or legal environment. So you've been using this particular platform. Like I remember in my college, there is a time in this case, ladies and gentlemen, we bought a very big screen, right? And we were able to put it outside there for purposes of what here? Advertising, trying to bring in people, right? For branding purposes. And then all of a sudden we realized that so many people were getting so many of our students from Facebook, right? When we have got a shift in technology, that should be an indicator of what here? Impairment loss. Ladies and gentlemen, remember even the concept of what here? Obsolescence, right? Where basically your asset becomes obsolete because you've got other asset which has been able to come up, which perhaps makes use of a different what here? Technology, right? So once you realize that there is a technological shift or even a legal shift, where, for example, there is a particular provision in the law which has been passed by Parliament, that, for example, from this particular period, we shall not be making use of this type of vehicles. and you happen to be having them, then automatically that signifies what here? A serious reduction in asset value. So those are the external indicators. Of course, as a student of CASNEB, you know that we can't really limit you to only 2. So if you're a serious student, you'll be able to come up with even more indicators and internal or external, or rather. Now, internal sources. Number 1, obsolescence or physical what here? Damage. Right? So an asset has been physically damaged. We have number 2, significant changes in the period or expected in the way the asset is being used, e.g. asset becoming idle. You are doing like 2,000 units a day, and then you start realizing that you're doing only 50, right? That, of course, shows what here that there is a reduction in the usage of the asset, which is an indicator of what here? Impairment, right? So we have here plans for early disposal or discontinuing, restructuring the operation where the asset is used, evidence that the asset's economic performance will be worse off than expected, e.g. frequent stoppages due to breakdowns that can lower the economic performance of the asset. When you realize, ladies and gentlemen, that you are entering into operational losses or where net cash outflows for the asset, the net cash outflows for the asset is bigger, meaning, ladies and gentlemen, that the cash outflows are increasing, right? The cash outflows are increasing at a higher rate than what you are receiving from this asset. That means what? So if it's a lorry that you have, you realize in year 1, maintenance was 10,000, and then all of a sudden, this lorry of yours starts, in this case here, damaging your pocket, say to the tune of, say, 50,000, 60,000 a year. And then when you compare the cash outflows versus, in this case here, what is bringing in the inflows, when you realize that the cash outflows are really increasing at a higher rate than the rate of increase of, you need to be very worried. There is what here? A damage in value. Great. Now, ladies and gentlemen, we have the last one here is loss of key employees. And this again takes me back to our screen at the college. It's a screen that we imported from China. We got one gentleman who came and fixed it very well up there, right? But all of a sudden, that guy could not be reached on phone. So most of the times, the screen remained out there off. So when you lose technical staff who are supposed to be running some technical machinery, technical asset, that automatically will, ladies and gentlemen, be an indication that you will not be able to get full use out of that asset. You need to start thinking of how do we impair the value of this asset in our financial statements, in our statement of financial position. You have to do something to its value. Great. Now, as we discuss this, remember this free of charge class is coming to you from RCM Publishers online classes, and this is our number. You need to get, ladies and gentlemen, to us, and automatically the moment you sign up with us, we are among the few institutions that will guarantee you a pass. Not because we are so good, but the major concept is we are the only college which is making use of what we call blended learning. Under blended learning, we normally fuse 3 things together for your success. What are we talking about? We have videos, right? We have online live Zoom classes and the RCM's what here? Revision kits, which will be given to you under what we call a premium package, which will cost you Kenya shillings 5,900 per subject, blended learning. Once you have access to all the videos covering the entire syllabus, you'll be able to run even faster than your teacher. So that once we give you those videos, we as your lecturers, what we do is to ask you to watch some 3, 4, 5 videos before a particular class. When I step into this class through the Zoom live, I'll only be tackling what here? The sensitive examinable areas from your past papers. So please support our program. Great, let's continue. So the impairment review, if you have been able, ladies and gentlemen, to realize that there are quite significant changes as you've discussed up there, it will be very important for you to relook at the value of your assets. If the carrying value of the asset is greater than its recoverable amount, it's impaired, and it should be written down to its recoverable amount. I'm repeating again that if the carrying value of the asset is greater than what you are able to recover from this particular asset, then that asset is impaired. So what is recoverable amount? It is the greater of fair value less cost to sell and the value in use. Value in use. So anytime they talk about this recoverable amount, anytime they talk about recoverable amount, always think about two things. Which things are these? Number one, fair value less cost to sell, less cost to sell, less cost to sell. And then you have got what we call value in use. Value in use, meaning, ladies and gentlemen, that for any particular asset that you have, you have got always two possibilities, two options. Which options are these? You can continue using it, and if you continue working with it, there is a benefit of using it, what we call the value in use. And this value in use, of course, we shall be looking at the benefit you are getting out of this particular asset. What cash inflows do we have? We subtract cash outflows. And then, of course, for those of you who did advanced financial management under Dr. Aura here, know that future cash flows must be discounted. So you're saying that this value in use will always be equal to the present value of future cash flows. So these future cash flows, remember, they've got to be net. And then, of course, fair value, less cost to sell. We'll ask ourselves a simple question. If you're selling this machine, first of all, what is the market value? Market value is the same as fair value. If the market value, for example, is 10,000 Kenya shillings, and of course, some of these assets, for you to sell them is not that easy. You must go and advertise them. You must at times get some brokers, agents, right? So if an agent is going to charge you like 2,000 to sell, the fair value less cost to sell will be the 10,000, the market value of the machine minus the 2,000. So anytime we talk over how much do we recover from these assets, we shall be looking at these two possibilities. Do we sell it? And if you're selling it, it's fair value, less cost to sell. Or do we continue using it? If we continue using it, then automatically we consider what we call value in use, which is present value of future cash flows. Now I'm coming to the tail end of this particular class. Our classes, we try to really go to the points. Great. So we have an example here. And before I go to this particular example, it will be very important for us to reminisce something here, that this recoverable amount, once you have these two values, for example, if you have got this being 10 and this, for example, being 7, the recoverable amount will always be, in business, you always go for what here somebody in business. You look at your options, you evaluate them. And of course, you go for the one that is more beneficial. So recoverable amount will be a comparison between the two, and we shall always work with what here with the higher. Great. So let's look at one example before we call it a class. So you're told here, a machine was acquired on 1st January 2015 at a cost of 50,000 and has a useful economic life of 10 years. At 31st December 2019, an impairment review was performed. So look at when we did this impairment review, 31st December 2019. So in this case here, let's count the number of years. Remember, we bought it at the beginning of 2015. Beginning of 2015, that's January. So 2015, you count 2015, 2016, 2017, 2018, 2019. It's the end of 2019. So in this case, it took us 5 years. There's a 5-year gap between acquiring the asset and assessing it for impairment, doing what we call impairment review. Great. So then the very first thing that I would want to do is to get the carrying value of this asset. And how do we get the carrying value? Remember, the carrying value is the net book value. And to get this net book value, we normally take the initial cost minus the accumulated depreciation. So the initial cost, this machine cost us 50,000. Depreciation, of course, per annum, this is straight line, so it will be 50,000. You divide by what here? You divide by 10. you divide this by 10, because the economic life they've told us is 10 years. But remember, this has to be total or accumulated depreciation up to the date of impairment review. And remember the date, by the time we're doing this impairment review, we had 5 years having lapsed. So times 5 here, times 5. Here we are, ladies and gentlemen. So you'll come and give me this figure here. So what do we have here, somebody? This is 5,000 times 5. That gives me 25,000. So 50,000 minus 25,000, that gives me a carrying value of 25,000. Great. Now the next thing that I need to do is to come and ascertain the recoverable amount. So recoverable amount is here. Recoverable amount is fair value less cost to sell. Do we have this? Do we have this? Do we have this? Check there. Fair value. So we are told here the fair value of the machine is 26,000 and the selling cost is 2,000. Selling cost is 2,000. So it will be 26,000 here, 26,000 here minus the selling cost, which are 2,000, which gives me 24,000. From there, we're looking at value in use. So value in use, ladies and gentlemen, they're telling us that the expected future cash flows are 5,000 per annum for the next 5 years. The current cost of capital is 10%, but fortunately, they have given me the annuity factor as 3.791. So remember, we say that value in use, if we continue using this asset, we've been told we shall derive a cash inflow of 5,000. It's an annuity. So if it's an annuity, then this has to be multiplied with what we call PVFA. So it will be 5,000 times PVFA, ladies and gentlemen, PVFA, which is what here? 3.791. 3.791. So times 3.791 times 3.791 times 3.791 using your calculators. What shall we get here if we use our calculator very well? If we use our calculator very well, we have 5,000 here. We have 5,000 here. We have 5,000 here. So 5,000 times 3.791 equals, which gives me 18,955. And of course, a prudent investor, if you're given 2 options here to follow through with their machine, with their asset, you always choose the better. So in this case here, the recoverable amount will be 24,000. Now then, what is the impairment loss? Go back to the formula. So this impairment loss, ladies and gentlemen, will be the carrying value, which was 25,000, if you remember this figure, minus the recoverable amount, which is 24,000, which will end up giving us an impairment loss of 1,000. So in my extract income statement, I know for this particular asset, I'll take, of course, a depreciation amount of how much? Remember the depreciation amount per annum, 5,000. 50,000 divided by 10, 5,000. And then I'll take the impairment loss of 1,000. And then, of course, in the statement of financial position extract for this particular asset, the amount which I will take there will be this recoverable amount of what year? Of 24,000. Of 24,000. Of 24,000. So, ladies and gentlemen, it has been a pleasure for hosting you around here. Remember, you're getting these lectures from RCM Online College. Our number is 0719 525,000. Bye-bye. Thank you.